My name is Will Bancroft. I'm co-founder of the real asset company. Today we're at the offices of Hinde Capital to talk to one of the gold market's best portfolio managers, Ben Davies. Ben, thanks for joining us today.
Thanks very much.
I wanted to return to some of your research last year. One of the themes that's fairly constant is this issue of default. So much of this depends on whether certain things are a credit event or not. And there's some interesting discussion last week from Jim Sinclair, another high-profile commentator in the gold market, about the role of ISDA, the International Securities and Derivatives Association, about the 5 largest banks that have written 97% of the credit default swaps against Greece, and what this really meant for the market and default this year, and debt restructuring. Pretty technical questions, I think you've probably picked up by now.
Right.
But can you give us some opinion on that, and bearing in mind that debt restructuring is a big theme for Hinde Capital this year?
What specifically did James Sinclair? I'm not completely au fait with what he said. I'm aware of his thoughts about ISDA.
At the high level, Sinclair's comments was that ISDA was an organisation run by the banks for the banks. So his concern was that 97% of these credit default swaps had been written by 5 of the largest US banks, and as a result they had a very strong interest to ensure certain things did or didn't happen with regard to a credit event. So
is he suggesting that they don't want a credit event to happen in this case?
That was the implication, yes.
Right. Okay. James Sinclair has been around a long time. He's a very savvy investor, so you have to take what he says and give him the respect he's due. Without knowing exactly what he said, but just sort of picking up, I think that obviously there is so much suspicion of banks and collusive behaviour that perhaps it's not inappropriate for people to have question the motives of some of the banks, and I can understand that. And JP Morgan, big exponent or big player in the silver market, and clearly there's some litigation going through with regard to their behaviour at the moment. In terms of the derivatives market, JP Morgan will be one of the, I imagine, the largest player. Well, they are the largest player. I think they're probably over 30%, if not more, of the derivatives market. So I think you could argue that there's a conflict of interest with regard to their positions with regard to an event, and the determination committee, which I think comes into play with this. But now, I'm not a credit default swap trader. I used to be a fixed income trader, and this would have been right up my street once upon a time. I've following these events only in regard to the legalities of default and debt restructuring in the European Union, which is of interest to vital importance to all of us in understanding the processes that are going on with regard to trying to solve the European Union problem. I think that if we use the Greek example, I would have to say possibly James Sinclair is perhaps barking up the wrong tree here, because unless I'm mistaken, the way I understand the market right now is that there is a 93% probability that there's going to be a credit event, which suggests that they're more than happy, these banks, or maybe they're positioned accordingly to benefit from it. But you remember that how is the market positioned? You'll have individuals the private sector, hedge funds might be example, banks, will have bought cash bonds. There's a 2-year maturity in March, 20th of March, which is why there's a time horizon here for the whole Greek debt restructuring and potential default that could be disorderly or not, depending on what goes through. But people would own cash bonds, and they'd own the they'd own the CDS, that's known as the basis. That package, I believe, is around 93%. So there's a 7% probability that it won't be a credit event. So that suggests to me that the big banks are clearly in favour of a credit default, credit event going through. But I actually, despite the determination committee, I think actually it's decided on now. You have auction processes. I think it's legally taken out of their hands about what is considered a credit event. Maybe that goes through the determination committee. Not completely sure on the complete details of that. I do know that in 2009, post Lehman and the 2008 debacle with Bear Stearns, that they did standardise credit default swaps, all old CDS, where you'd actually write a CDS on a corporate or on a sovereign, would be between several counterparties or one counterparty, and it was a specific contract between those individuals. That's been completely removed. As I say, now they're standardised. I think you have this determination committee. I think there's the 5-7 big banks, and it's based in 5 different continents, I think, as well, if I recall correctly. So I think it's referred to as the Big Bang Protocol in 2009. All that changed. Anyone who had the old CDS, they're not worth the paper they're written on, or there will be no market for it. You need to take up this. This is how they will be settled: physical cash settlement, physical and cash settlement through an auction process. So, in terms of right now, in terms of James Sinclair's view about ISDA, yes, you could argue the biggest player might be incentivised to persuade a committee, by the sounds of it, that perhaps this shouldn't be a credit event. But I believe that there's pretty strict guidelines, legal guidelines of what determines a default. So anyway, going back to, it's a bit belaboured, but laboured, going through to the Greek situation, there's a debt restructuring going on. As part of that, you need to get the debt to GDP ratios need to be around 120% by 2020. Obviously, with events in the world at the moment that are ensuing the ongoing economic contraction, the austerity measures that need to be in place have become even more draconian. As part of the debt restructuring, there's a voluntary element to it, which is there's a private sector involvement. Right now, a lot of hedge funds and even some banks own cash bonds, and they are long CDS, so it's not a naked CDS position. In fact, you can't have that on sovereigns now, I think, since the start of 2011. So all these are mark to market, and obviously at the moment that mark to market suggests there's going to be a credit event. It's not in their interest in many ways for there to be this haircut, which is anywhere between 50 and 75%, and maybe there's going to be a higher coupon paid out over 30 years. And just to rewind, what's the debt restructuring? We're just trying to mitigate, reduce the payment issue by extending the maturity of the bonds over a 30-year period with ratcheting coupons. And it just makes it a bit easier for Greece in order to remain in the financial markets and still issue debt. Obviously, they don't want this. They don't want to have this voluntary payment. I think, in reality, that there's going to be a holdout by these guys. So what I think is going to happen is that we'll probably see invoked what's called collective action clauses, which on the domestic debt, the Greek debt, doesn't exist. This basically means that there would be an enforcement that those that hold out just get forced into the debt restructuring. Actually, what I understand in that event, that would be considered a credit event. So in many ways, I think that it's going to come to pass in that light, and that's what the market's premising on. That's my 2 pennies worth on it, anyway.
Thank you. And when you look at the political situation in Greece, if we withdraw from the tactical stuff for a bit, at what point does this become too burdensome for the Greek politicians? Bearing in mind they have to get re-elected, they have to have a mandate. It's a fine balance here between the interests of the European Union, its currency bloc as a whole, and individual destinations. How do you see that balance at the moment?
Well, that's an interesting point you bring up. In reality, what you're saying is, what could be the eye in the ointment, or the fly in the ointment, sorry. Yeah. It would be, what would prevent this debt restructuring going, and it's considered to be a credit event.
Give us a little bit of feet dragging by Greece the last few weeks.
Yeah, I mean, maybe that's, there's a bit of power play between the euro area and Greece. Both feel they've got a position of strength, and perversely, even Greece thinks they might have a position of strength because they realise that if they hold the exit card, that could trigger something greater. I think actually those risks have been diminished by the ECB providing the 3-year LTRO. Obviously that just kicks things down the road. It doesn't solve anything, but it does give them a lot of time. So I think the systemic risks have been reduced greatly should there be a disorderly default as opposed to this debt restructuring, which is effectively a orderly default. I think that the fly in the ointment with regard to Greece is that they say to themselves, gosh, you know, conditions have got so much worse, but now they're being asked to do private sector wage cuts, enforce that. You know, how do you do that? That's a pretty interesting dynamic, because obviously you're now the government is becoming very interventionist, and although it's a pretty public sector driven economy, you know, things like that change the dynamic of the social dynamic of a country pretty quickly, and that causes civil strife, and that would be an issue for the PASOK and the incumbent government and re-election. There's also talk about, you know, much more greater public sector layoffs. There obviously comes a point where it's a tipping point, I imagine, for a politician in Greece, where he goes, you know what, it's so draconian what we're having to undertake, and it's going to last not just for a couple of years. I mean, let's face it, there's going to be another debt restructuring from the way I look at the maths in the next couple of years anyway. So this is just one of this is the second bailout, the first debt restructuring, then there'll be another debt restructuring. It's just the first of many hurdles, and at some point you might go, gosh, it's not worth it. We'll take our chance, and we'll drop out. We'll completely exit. We'll default. In which case, Greece will be in a situation where they would have to put up currency, have a currency law change, which means they redenominate all contracts into a new currency, whatever that be called, maybe the new drachma, blah blah blah. There would be capital controls, absolutely, although I would say most capital has probably already fled the country, but you try and keep in as much capital. The reason why it just seems unlikely that that would happen is because I think that the middle class, which is very evident in Greece, would get wiped out immediately. There'd be very high inflation. They're not an autarkic country, i.e. they're not self-sufficient. They'd be in a very untenable situation, have no access to debt markets. So it's very unlike what happened with Russia, when really the rest of the world was really actually doing okay, and we had sort of good growth, moderate inflation, and they were able to come back to the market earlier. I think it's a very different situation. With regard to the European area's view on this, I think their patience for Greece is getting diminished. They don't want to create a moral hazard whereby they give them more bailout money and they don't get the austerity packages pushed through by the Greek government, because otherwise that sends a terrible signal to other peripheral countries who just go, hey, well, what Greece did, we're going to behave in the same way. And also, to my mind, you could look at it this way: if you can avoid the systemic risk, which I think now that so much Greek debt has been, people got out of positions and it's all being marked down. The ECB holds an inordinate amount actually on their balance sheet, which actually comes into, I'll come back to that point actually. I'll ask about these 2 years again. I think that you'll be in a situation where Europeans will feel actually we become stronger as a fiscal union if we move towards that, and that transfer union, if an individual drops out, particularly as they're going to have to provide hundreds of billions of dollars still in years to come, most likely. And actually that leaves more money available, maybe 130 billion, second bailout, perhaps for Portugal and others, that bolsters the system. So it's a long-winded answer, I know, but I think that's the two dynamics at play here.
And then it feels like a lot of the dynamic there is less stressed markets because of exactly this ECB activity we've been talking about. LTRO, we've seen the huge levels of subscription to this, banks parking questionable assets with the ECB.
Yeah.
This is more kicking the can down the road. How long can this continue? You know, how will this dynamic continue to play out? It's interesting to see the size of the ECB balance sheet now rivaling the size of the Fed's. Is this a sustainable situation?
Well, yeah, and I wanted you to bring up the ECB and to just veer the question slightly towards the debt restructuring with Greece and the amount of Greek debt that the ECB holds, obviously through their bond purchase program, the SMP, Securities Market Program. They finance Greek debt that took it onto their balance sheet. I believe it's around 50 billion euros, dollars. I haven't looked at the numbers recently, but I'm sure it hasn't changed. They bought it at an average price, I believe, around 80% of face value. So that puts them on the hook for 38-40 billion dollars worth, or euros worth. At the moment, that Troika, ECB, EU, IMF are trying to, they don't want a credit event triggered because obviously they would then have a bunch of defaulted loans, bonds on their balance sheet. Now I think the ESM being brought forward, they could actually put those onto the ESM not balance sheet. Yes, it would be onto their balance sheet because it's like a bank. And that would avoid that situation, but it seems rather duplicitous that the ECB should get seniority in this whole bond restructuring. They don't have to pay, and that's why I think private sector guys would hold out. So hang on, what's fair for us should be fair for you. So I do think it will be. So I do think, as a market pricing, it will be a credit event. The risk is that a Greek politician throws his arms up in the air and goes, "I'm not having it." And that's possible, but I think the euro area might actually just go, you know what, maybe just get rid of Greece now because of this, as you say, this 1 year LTRO. It's all debt restructurings, all defaults, it's all about buying time. If you can spin it out over a 10, 15, 20 year period, at worst, at best, you prevent the system from potentially collapsing, which is what their fear is and the fear that they're trying to pass on. And I think the system has got so bad, and Austrians or economists will shoot me for this. Bear in mind, I have a leaning to that side of things, as people well know. I think the system's got so large, the leverage is so great that you really have to try and let the air out slowly. Unfortunately, a wholesale
retreat.
Or a wholesale default with all the rehypothecations with MF Global, this so entangled now that the economic system would collapse. So I don't really have, unfortunately, I haven't thought of a really brilliant solution to a terrible mess, because I think it's much more complex than let's just liquidate. I just don't think I think that's insanity.
Well, Ben, thanks for your time. Rehypothecation and hypothecation there. Other good questions for another day, but for today, thank you very much for your time.
Thanks very much, that's great. Thanks.
That's all from us today at Hinde Capital. You can see more of our videos on the website in our research and analysis section, subheading guest interviews. Thank you.